Hi, this is your host, Andrew Rafal, the founder and CEO of Bayntree Wealth Advisors. And I want to welcome you to the Your Wealth and Beyond podcast, a show that was created to help you simplify the financial world and to ensure that you're living your best life now and in retirement. Each show, we're going to be bringing on experts that are going to help you build wealth and, most importantly, find purpose in what matters most.
Welcome, listeners, to an emergency episode of Your Wealth and Beyond. And before we jump in and talk all things on the CARE Act that just recently passed by the Congress, how it's going to affect your retirement, wanted to send positive thoughts to all of you that you're staying healthy, and together we're going to get through this tough time. Now, with everything that's going on, Congress has recently passed the biggest stimulus bill that we've seen in our lifetime, and it's going to affect all of us, whether we're a business owner or individuals. And today we're going to talk about how this is going to affect our retirement. And who better to help us disseminate this info than a good friend and a mentor of mine, Ed Slott, who's back for the second time. Those of you that know Ed, he is known by the Wall Street Journal as the best source for IRA advice. I've known him for over a decade, and today we're going to walk through some of the fundamentals of the act and how it's going to affect your IRAs, your 401ks. If you have to take out required minimum distributions, what's that effect here in 2020, as well as the changes to the tax filing deadline here in 2020, and in conjunction with that, IRA and Roth IRA contributions. So we're dedicated here to get the information out to you as fast as possible, and that's what we've done here. So without further ado, my emergency podcast with Ed Slott on the recently passed CARE Act. Welcome back to another episode of Your Wealth and Beyond, and I've got a good friend who is back for the second time. Ed Slott, welcome to the Your Wealth and Beyond podcast. I know you've been very busy over these last few weeks.
Oh, yeah, lots of tax changes, but great to be here with you, Andrew. Once again, you're at the top of your game getting this information out, and it's coming out so quickly. Luckily, you are taking the education and our resources, and so you can be a big help to your clients to have this information almost instantaneously, like right now.
Yeah, and it's times like this where there's just so much uncertainty and so much chaos where we want to weed through the noise, bring in the professionals, and just help you as the listeners and the clients, prospective clients, just figure out how to best take advantage of what the government's doing to help prop the economy up. You know, I'll tell you, I've had so many Zoom meetings the last week. If I never see a Zoom again, I'll be happy.
You know, I guess it's not funny, I was going to say, but I saw a story where Zoom had to cancel their conference because of this. Why are they having a conference? They're Zoom.
Yeah, it was like 800 attendees. I was thinking the same thing. We chatted just before we jumped on here about how it's tough in the dating world right now if you're single. And, you know, the one thing is, I have a 14-year-old daughter, and, you know, on that side, I hope this thing lasts for a long time, the social distancing.
Oh, boy, it's rough. I don't know what I would do.
Okay, so so Congress came together and they put together a bill of all bills, a stimulus plan for the ages. So listeners, what I wanted to do is bring Ed on, and we can go through high level how some of these things are going to affect you. And we're going to really talk today more on the retirement side, the retirement accounts, what's in there for each of you. There'll be show notes. So Ed, let's jump in and talk about what you see as one of the major items that was in the CARE bill that just passed recently.
Well, it all depends on your perspective. You know, if you're a big corporation, the major item is the $50 billion you're getting. But let's get down to reality. What are actual people getting? And for those with retirement accounts, one of the items is a waiver on RMDs, required minimum distributions. Most of you know that now, the new age, once you turn age 72, you're forced to start taking money out and paying tax. Well, Congress saw this as a problem, rightfully so, and waived all RMDs for 2020. So that means you don't have to take the amount you would have had to take, which means you don't have to pay the tax, which means you're going to have a lower income and a lower tax bill. Now, if they didn't waive this, can you imagine? Remember, 2020 RMDs would have been based, or are based, on the December 31st, 2019 balance. On that date, the Dow was around 28,000. So you would have been forced to take a larger chunk of money out of your IRA and pay tax on value that no longer exists. So it's a good provision, and you have to make sure you know about it so you don't go ahead and take the RMD, because now you don't have to.
It's a little added, it would have been added insult to injury, and it's similar to what they did in 08, 09, except the difference was in that bill, you still had to take it out in 09, and then they gave you the reprieve in 2009. So 08, you still had to take it out. 09, you didn't. So here, listeners, as Ed brought up a good point, a lot of you have set up to have automatic distributions from your IRA to cover the required minimum distributions. So it's important that you go back to your custodian or you call up your advisor. Your advisor may not even know about this. Call them up and say, hey, I don't want to take my RMD out for this year. I don't have to. And then make sure that you get the letter of instruction to the custodian to stop that payment for this year. Now, Ed, what if you were one of those high achievers and you took out the RMDs already before later in the year? What's that person do?
Well, there's no plan in the relief package to put them back, but some people may qualify to put them back because normally an RMD cannot be returned to an IRA, cannot be rolled over, because if you could roll over an RMD, they would never come out. They'd come out, you put them in, you come out. So in the law, you're not allowed to put back an RMD. But now, because this law effectively says the RMD you took is no longer an RMD, it may be eligible to be rolled back over to your IRA, assuming you catch it within 60 days and assuming you haven't done another IRA to IRA rollover in the past 12 months. So if you qualify on all of that, there's a good shot you'll be able to put that money back into your IRA and alleviate the tax bill. Now, back in 2009, when this happened, later in the year, IRS eventually granted blanket relief for everyone and let everybody put the money back. So maybe we'll see something like that later in the year. There's nothing in the law that allows that now. So just sit tight. If you don't qualify under those conditions, IRS may come up with some relief for this.
And when we talk about procrastinators, last year, 2019, if you were pushing off your RMD till April 1st of this year, what happens to those people who had to take a 2019 RMD but were planning on waiting until 2020? Do they fall under this same guideline as well?
Yes, that's an excellent point. Actually, anyone 70 and a half, we know they changed the law to age 72 for RMDs, but not everybody got that break. If you turned 70 and a half in 2019, you didn't get to jump to 72 and skip a year. So you did have to take an RMD for 2019, but it wasn't due, as you said, till April 1st this year. If you waited and didn't take any of it in 2019, then you would have been subject to take the first one by April 1st and your second one by the end of this year. If you didn't take anything in 19, you could actually waive your first two RMDs.
So we're giving some onus to a procrastinator there. Good for you guys out there. Wow. What about inherited IRAs? Does the law affect the inherited IRA the same?
Yes, inherited IRAs, those RMDs are waived. Now, the only thing is, it doesn't help everybody because according to the government statistics, 80% of people with RMDs and IRAs, they take more than the minimum anyway because they need the money. So obviously, if you need the money, you're going to take it. So this doesn't help you. But what it does, even if you're in that situation, you're not constrained by any minimum. Remember, the required minimum was a minimum. Now that it's not there, you can take any amount you want. So somebody had asked me, is there a downside? What if I want to take the money? And you might say, who would do that? Well, maybe you're in a low bracket and you say, this may be an opportunity to convert to a Roth IRA. Market values are low, tax rates are low. It's no longer an RMD. Under the regular rules, RMDs cannot be converted. But since this money is no longer an RMD, maybe you can take it and convert some of that money to a Roth IRA, taking advantage of low values and low rates.
Yeah, turning lemons into lemonade. So
Yeah.
that's a great point there, Ed. With we talk a lot about on this show is Roth conversions, Roth conversions. Those of you over 70 and a half taking those RMDs, you could still do them, but it's made it harder when your tax bracket would go up. So this is a perfect time to review that. And Ed, like you said, if the stock market is on sale and we can position money from the IRA into the Roth at lower taxes, not having to take the RMD and getting it into hopefully inside of the Roth for higher growth. When things are on sale, we want to move it to a bucket that is never taxed. So have these conversations with your advisor. If you're not, you can always reach out to us here at Bayntree and we can walk through what the ramifications would be, both paying the taxes today versus the savings later for the rest of your life. So take advantage. Look at these silver linings. When we have all of this darkness out there, let's find the positive and let's take advantage, especially when the Congress is giving us this gift. Let's take full advantage of it.
One other point, Andrew, if you don't take advantage of it, I think Roths, as you said, are not only on sale, but if you don't act now, and this is not like a infomercial, act now. if you don't act now, given that they just opened up the Treasury to the tune of $2 trillion, obviously that money has to be paid back. I think that makes more of a case that tax rates maybe go up in the future to pay for this. So this may be an opportune time to get it out before they lower the hammer on you.
That's an excellent point there. Okay, so we talked about RMDs. Obviously, that's not going to affect all of our listeners out there. Let's talk about the provision in regards to distributions from retirement plans or IRAs. What did they put into the bill that's going to allow for a little bit of flexibility this year to help people weather this storm?
Well, these are relief provisions, which I hope nobody uses. Let me preface it with that. There are two relief provisions, and there are no really free lunches here. The first one is penalty-free distributions. Normally, if you take a distribution from your plan or IRA before you hit 59 and a half, you'll not only pay the tax, but also a 10% penalty. Well, if you've been affected by the virus situation, the financial situation, and related items, you've been furloughed, laid off, or your child care, there's all kinds of situations. It's really all encompassing. And you really need to hit your retirement savings for desperately needed money, you won't pay a 10% penalty, but you still will pay the tax, although they're letting you spread the tax bill over 3 years to soften the blow. And if things turn around for you, you could actually put that money back, repay it, and remove the tax bill. But it sounds good. I wouldn't want anybody to run out and do this. I call this a Hail Mary provision. The last thing you want to do is withdraw early from your IRA for non-retirement reasons. Yes, I understand if it's a desperate situation, but this should be a last resort. You should look at any other source of money before hitting your retirement funds, because if you drain those funds, what will you have when you need the funds in retirement? So if you're in dire straits like this, yes, it's good that the provision is here, but I hope you never have to take advantage of it.
And the mechanics of that, so you're saying we have to pay the tax over those 3 years.
You could spread the income. Let's say you took $60,000. So you would report $20,000 of income in each of the 3 years.
And then putting the money back, there's no 60-day limit on this?
Anytime within the 3 years, and you can get your tax money back.
Excellent. So, listeners, if you have to do this, and again, we're hoping you don't, but just to keep accurate accounting of what you've taken out this year, because all of those funds will fall under that guideline that over the next 3 years, if you get back on your feet, we can always fund the IRA or the retirement account, and then you won't have to pay taxes at all. Whereas listeners of this show and those who follow Ed know that there's a 60-day rule when we take money out of an IRA or a 401k. Now, question one more on this with that 365-day rule. Let's say no,
it doesn't apply to this. In other words, this is a special relief that lets you put it back anytime in the 3 years.
Okay. And listeners, again, we're just telling you what's in the bill. We're not recommending you go do this, but it's good to know what the facts are. And then in the scope of another area where, again, we're not big proponents of, but on 401k retirement plans that do have a provision to take out a loan, what did they position inside of the care bill that's going to help people out who are in dire need?
They expanded the loan provisions. And as you say, and I agree with, a desperation, last-ditch effort. You don't want to borrow. Now, what's better than the hardship distribution we talked about is subject to tax. The loan is not, but it has to be paid back. And if it's not paid back, it could be subject to tax and a penalty. So for those affected by the virus and the related financial problems connected to that, they raised the 50,000. Normally it's a 50,000 limit to 100,000. Obviously you have to have 100,000 to borrow 100,000, but you could borrow up to 100,000 or 100% of your balance. So if you need it. Now this does not apply to IRAs. You can never borrow from an IRA, not even under this relief package. So this is available. Also, if you already have a loan or taking a loan, the repayment date has been extended for a year to give you some help on that. But again, I hope you never have to use this. You should just know it's there, but it has to be repaid. I guess the good side is if you repay it to yourself rather than a bank.
Yeah, just be careful on these. We've seen they're very complex and people get into trouble, especially when they change jobs and need to move the money out. Then it becomes taxable at that point, whatever that loan is. So try as best you can while you're working to build an emergency fund for situations like this so you don't have to tap the retirement, because that's what those funds are there for retirement. And if you're going to be in retirement for 30 plus years, we got to count on having something there. Okay, the one of the other items, and as a I guess a recovering CPA with still some clients, this affects you. For all the listeners out there, this affects everybody. About a week or so ago, the Iras came out with the guideline that they're pushing back the filing deadline from April 15th to July 15th. So, Ed, walk us through what that means first on the tax side. Do we still have to make our payments if they were due in April? And then let's talk about the positive of having a little bit more time to fund your IRAs or your Roth IRAs or your HSA accounts.
Right. Well, the Treasury Department, the government, extended the normal April 15th filing date. Everybody knows about that one, from April 15th to July 15th. But even before that, a few days before that, they also extended the date you can make payments. So if you owe money, you don't have to pay till July 15th. If you pay estimated taxes, the first quarter, as many people know, is due April 15th. That has been pushed back to July 15th. But in a strange twist, and I don't know why they did this, it's the first time I've ever seen this in over 40 years of taxes. The second payment, if you pay estimates, is due June 15th. They did not extend that date. So now your second installment of estimates is due before your first installment. That's going to really play havoc with everybody who gets a tax return back through their tax software, because they've always been coded to come out in order. And now they're not in order. Your first payment is due June 15th. It's kind of messy. But anyway, you do have that time. You will not get any interest or penalties as long as you pay what you owe by July 15th. So because they extended the filing due date, they also automatically extended the date by which the deadline for making IRA or Roth IRA contributions for 2019. The general rule is for 2019 or for the prior year, you always had until April 15th of the next year to make your contribution. And there was never an extension on that. Even if your return was on extension, you still had to get that IRA contribution in by April 15th. That's still the case. But what they did is, because the IRA contribution deadline is tied to the tax return filing deadline, automatically now you have until July 15th to make an IRA or Roth IRA contribution for 2019. So that helps, because Maybe your financial, look what's going on. Your financial situation may have changed. You may have been a person that puts in every year, but this year maybe there's a loss of job, loss of business income, other things going on. It gives you more time to see if you still have the money to make the contribution, still want to make the contribution. So you don't have to make that decision until July 15th. The only thing I would say is, because this is so new, if you're going to make an IRA contribution for last year, 2019, after April 15th, make sure to write on your check that it's for 2019. I think this is so new that many of the financial institutions will automatically code any IRA money that comes in after April 15th as 2020 contributions. So I would make sure to code your check, write on the check 2019 IRA contribution, and then confirm back with the custodian wherever you have your IRA funds that they in fact credited that to 2019.
And is this the same for health savings accounts? Do we also
Yep.
get the
Yep.
okay?
Yep.
And those listeners of the show and followers of Ed know that the HSA is the best of all the retirement accounts, because you get all three. You get a tax deduction, you get to grow it tax deferred, and then if coming out for qualifying medical, it comes out tax free. So it is the Cadillac of what's out there. So
that's right.
If you haven't funded or weren't able to fund it, you've got extra time to put that money in. We know healthcare costs are just going up, so you might as well use that to your advantage. And if you put money in the HSA, then it allows you to potentially even do a Roth conversion and look at breaking even on the taxes on that. So all of those different things we look at for our clients. Ed teaches us, and the other 400 plus advisors that are part of your group, Ed. It's all these things we call little wins. Let's get little wins. Let's help you understand the tax code. Let's see what's out there for this year and take advantage of it. One last question. This is more not again for everybody. I actually have the question too because a client brought it up. QCDs. Okay, so if we have no RMDs this year and you want to take advantage of a qualifying charitable distribution, how does that work? Are we still allowed to do that in this year?
As long as you qualify. If for IRA owners who are 70 and a half years old or older, you can still do a QCD even if there is no RMD. It's the better way to give your money to charity. And if anything, even though there's no RMD, it still knocks down your IRA balance at no tax cost.
So listeners, if you want to take advantage of the QCD, it's a no-brainer. Even if you're donating just a little bit, you might as well do it there versus doing it inside of your after-tax bucket, because most of you out there are using the standard deduction. So in this case, this allows you to position money to a charity, to a foundation, to a faith-based organization, and not have to pay the taxes. But as we've talked about in previous shows, make sure that the custodian is not going to tell your CPA or in the 1099, it's not going to show that you gave X amount of dollars to that institution, right, Ed? So you've got to be careful of accounting for that.
Yeah, that's exactly right. So I want to point out that these are the kind of things, like, you are so up on it. And I think your listeners, you probably already know that you're a member of an elite group, Ed Slott's Elite IRA Advisor Group. And this is where you want a professional, with all that's going on with the virus, everybody's saying, where are the experts? Well, it's the same thing with your finances. There's a time that you have to go to somebody that has specialized knowledge. And most advisors don't. Andrew's been training with us for many years on the tax ramification, all of these things. That's why he's so up on it. As you know, Andrew, the minute something breaks, you're informed and you can connect with your clients and make sure they can take advantage of it. It's a big advantage to working with an educated, competent advisor.
Yeah, I mean, you think about this. The bill just passed. You and I are on the horn right now, and I know how busy you are with Wall Street Journal and investment news and everything else that's out there. So we're able to get you on the show, and then listeners, we're able to get this out within 2 days. Look at that turnaround time, and we help decipher through. You're going to have a lot of info that's thrown at you. That's the key, is let's disseminate that, and let's bring to you what is going to make the most sense to help you in your retirement. So Ed, as always, wealth of knowledge. Always have a blast talking through this. We make taxes sexy, and that's the key, and simplifying it. So I appreciate everything you're doing.
You too, and I hope everybody stays well, health-wise and financially.
Touche. So that's the key here. So listeners, if you have any questions, there'll be everything in the show notes. And then there's an easy way to contact us. Even if you just have a question, we'll be able to give you some answers, and then you can take that so you can make really good, sound financial decisions. Thanks, listeners, and stay tuned later this month for another episode of Your Wealth and Beyond. Happy planning, everybody, and stay healthy.
Thank you for joining me for today's episode of Your Wealth and Beyond. To get access to all the resources mentioned during today's podcast, please visit Bayntree.com/podcast. And be sure to tune in later this month for another episode of Your Wealth and Beyond.
Investment advice is offered through Bayntree Wealth Advisors, LLC, a registered investment advisor. Insurance and annuity products are offered separately through Bayntree Planning Group, LLC. Bayntree is not permitted to offer, and no statement made during this show shall constitute legal or tax advice. You should talk to a qualified professional before making any decisions about your personal situation.